Module 2, we'll be going over technical indicators before we get into chart patterns and candlesticks in Module 3. Before we get into the meat of the course, just a quick note on technical indicators. We'll be going through a lot of technical indicators and chart patterns through the next several videos. Don't get hung up on trying to implement all of the technical indicators at one time. Pick one indicator to get to know well and see if that fits your style of trading. You can add in a second or even a third indicator slowly as you become more comfortable using the indicators you choose to get to know. It can be frustrating when two indicators give you opposing signals to buy or sell a stock. Also, be aware that some indicators work better in certain markets and with certain stocks than other indicators. It's also possible that one indicator works well with a stock for a period of time, and then the indicator doesn't work as well with a stock, but another indicator will. Just a couple of points as we begin talking about indicators. All right, let's jump into support and resistance. The basic idea with support and resistance is that you'll be buying near support levels and selling near resistance levels. Note, I don't say sell at resistance levels or buy at support levels. Depending on your trading style, you may want to let the stock go through the level to some degree before initiating a position. Often a stock will break through a level by a small amount and then bounce back off of that level. No matter what main indicator you're using or what time frame you're trading in, you should always be aware of major support and resistance levels for your stock or market. Now, on that same note, as we talked about in a previous video, you should always look at a larger time frame to get an idea of the trend than the time frame that you're currently trading in. Support and resistance levels are so important because they can indicate a major change in a stock that is trending. If you're trading an hourly chart and a stock that you know is bullish and you aren't aware of a major resistance level, it can really throw a wrench into your trading. And finally, a stock that is breaking support or resistance levels, especially on heavy volume, which we'll see in a few charts in just a minute, could be setting up for a major move. As with all technical indicators, support and resistance levels are important as a predictor for what direction a stock will head. But as any technical indicator can be wrong, support and resistance levels are broken all the time. So even if you're trading around support and resistance, you still need to be nimble in your trading. And as always, stick to your trading plan. Now let's get into the charts. Let's look at a daily chart of Bank of America for how to trade resistance. I've drawn a resistance line here at around $25. The stock went up in July of 2017, traded around the $25 level before dropping back, and went up again in August to the $25 level before dropping back, and then traded up again in September to the $25 level. It's a pretty good resistance level at this point. We've been trading at this level for about 3 months. BAC broke above the resistance level on September 20th and 21st. But as you'll see, as the stock moves above the resistance line, the volume is normal for the stock. What we'd like to see is a higher volume trading day when there's a break of resistance. We won't really see conviction of the buyers in the stock and know that people are piling into the stock as it breaks above the resistance line. The same thing when we're looking at a support line. If we're looking for that to break and for the stock to break down, then we're also looking for a high volume day. So here it didn't confirm the breakout with volume, and the stock pulled back a couple of days later. Then on September 27th, the stock breaks above the resistance line with high volume and finishes up about 1.5% above the resistance level. Let's talk for a second about when you want to enter a trade when a stock is breaking resistance. Generally, you'll look for the stock to trade at least a couple of percentage points through the resistance or support level in order to take on a new position. Otherwise, you're going to get whipsawed around the support or resistance level. Again, look at this breakout on the 20th and 21st. If you'd bought there when the stock finished about 1% above the resistance line and you had a stop between 1 and 2% below the resistance line, you may have been stopped out at this point. And then you have gotten back into the trade here. You can manage your exit and entry points around support and resistance lines by allowing the stock to move a few percentage points either above or below the line before entering the position. Now let's take a look at Bitcoin. We're going to start out on a daily chart. We're trading hourly. So we're looking at a daily chart to get market direction here. We know the cryptocurrency has come down from $20,000 to the $6,000 range. But if we look at the daily chart on a long-term basis, 6,000 was a resistance level back in October of 2017. The stock went up and came down and touched it in November. It came down and bounced off of the 6,000 level in June. And now it's trading back down around the 6,000 level. Now I'm going to zoom in to an hourly chart. And I've already drawn an hourly support level here between 6250 and 6300. I'm going to back out one level. So if we were going to trade the stock long with the idea that it's at a support level, we'd want to make a purchase somewhere in the 6250 to 6300 level when the stock comes back down. Let's talk a second about first what type of profit you would need in the stock and what your stop would look like and how you can control risk in an instrument that's trading at $6,000. First, if we're buying in the 6250 support area and we know the stock's been trading up to around 6600, so that's the profit we're looking for. So that'll be about a 5% gain if we buy at 6250 and sell at 6600. If we're looking for a 5% gain, we want our gain to be at least 2 to 3 times the size of the loss that we're willing to take. And in some trading systems, that's going to be even higher. So a 1% loss here would put us just below the 6200 level. We may want to set our stop at 6190 just so it's not at a whole number and we'd risk 1%. So what's one way we can manage risk in a $6,300 trading instrument? And that's with sizing. Anytime we put on a trade, we want to make sure that the size of the loss we can take works with our trading plan. So in an instrument like Bitcoin, if we want to limit our risk, then we just limit the size of our trade. And it's the same for any trade you enter into, whether you're trading a penny stock or a $6,000 instrument like Bitcoin. You always want to look at the size of the trade and what a loss on that trade would look like in your account. The first thing you should always ask is how much money I can lose on this trade, and clearly define that. Once you start it with that baseline, you can set your profit target, knowing that you're going into the trade with a well-defined profit and loss parameter. Thank you for taking the time to watch this video on support and resistance, and I'll see you in the next video. Technical indicator video. And today we're going to be talking about Fibonacci lines and extensions. So let's get right into Fibonacci lines and extensions. Fibonacci lines are a technical indicator devised from a ratio devised by Leonardo Fibonacci, an Italian mathematician. The lines, when displayed on a trading chart, give likely support and resistance levels for a stock based on prior price action. So let's say you have a stock in an uptrend and it's hitting prices that it's never seen before. So you have no current resistance levels. When the stock reaches a certain level and begins to retrace, it's difficult to identify any levels that the stock would retrace to because you don't have new support and resistance levels. With Fibonacci lines, we get likely support and resistance levels even though the stock hasn't traded at those levels previously as if they were support or resistance. The golden ratio in Fibonacci lines is the number 1.618. The financial world has taken that number and applied it to Fibonacci lines, which you'll see on a chart in just a minute, and the important percentages derived from the golden ratio are 38.2, 50%, and 61.8%. Those lines help provide the support and resistance levels at which a stock is likely to trade, even though, as I stated previously, the support and resistance levels have yet to be established. So let's take a look at how Fibonacci lines play out on the stock chart. We're going to start with a daily chart of Intel and draw our Fibonacci lines from the low established in July of 2017 to the high established in June of 2018. So on the left-hand side, we'll open our drawing tool. We'll go down to Fibonacci or Fib retracement. Click that number. Move this out of the way. We're going to place our cursor right at the low and drag up to the high and click there. Now we have our Fibonacci lines. As you can see, the key numbers we talked about, 38.2, 50, and 61.8. As you can see, 61.8% was support in this bullish move on several retracements. So now we're going to pull our chart forward, we can grab this right side of our Fibonacci lines and pull them forward. As long as we keep the top line on the high, the bottom line will stay anchored to the low. And we'll see as the stock has started a retracement, it's pulled back to the 38.2% line, and our next retracement can be expected to go to the 50% line, and that would become a support line, just as the 38.2% line became a support line. You had a slight bounce, and now it's trading around that support line right now. So these are our expected retracements with Fibonacci lines. So now let's take this same chart and go to a monthly range. What we're going to do is place our Fibonacci extensions on this chart as well. So we're going to take the low, 7 January of 09. We go over to trend-based Fibonacci extension. Click that. Place our cursor on the low. We're going to pull it up to the high here. Click our cursor. And then we're going to drag the bottom of the Fibonacci extensions down to the first retracement here. And now we can predict where we'll run into resistance as the stock continues up. The 38.2%, which is around 64. The 50% line, which is close to 70. And then finally the 61.8% line, which is around 75. And if you'll note, the 61.8% line is also the high that the stock reached in 2000, just before the dot-com crash. So these lines, even though we don't have current resistance points in the stock, if it continues to move up, these lines will give us projected resistance points that we need to be aware of when we're trading. So that's how Fibonacci lines can give us retracement levels for a stock that's in a bullish pattern, as well as projected price levels of both support and resistance for a stock that's in a bullish pattern and reaching new highs either not seen or not seen in several years. As I said earlier, Fibonacci lines and extensions can be used in any time frame. So we can take those same lines, the way we just drew on the daily and monthly chart, and apply those to an hourly and a minute chart. Thanks for watching this video on Fibonacci lines and extensions, and I look forward to seeing you in the next video. So let's talk about exponential moving averages. A simple moving average is calculated by adding together prices in a given time frame and dividing by the number of time frames. So if we're looking at a simple daily moving average, we're going to take the closing price for a certain number of days, add those numbers together, and then divide by the number of days. So say we're doing a simple moving average for a 10-day period. We'll take the closing prices for the past 10 days, add those together, and divide by 10. An exponential moving average is a weighted moving average. So the final few days of that moving average, using our daily example, would be more heavily weighted. Both the simple moving average and the exponential moving average are based on historical prices. One question is, how does the moving average based on historical prices help us predict future prices in a stock? As we'll see in the chart in just a second, an exponential moving average by itself isn't extremely helpful in predicting price moves, as by the time the moving average is changing direction, the stock has already moved in that direction. But a two-line exponential moving average can help us know before it's clear on the chart whether a stock that's trending is slowing in that trend and may be about to change direction. When we use two EMAs with different time frames, we get an indicator when the fast line or the signal line, which is the lower number of time frames, crosses the slow line, which is the higher number of time frames. And we'll look at an example in a chart in just a second. A golden cross, which you may have heard talked about in the press, is when a short time frame crosses a much larger time frame. So one example would be if a 50-day moving average crosses a 200-day moving average. That doesn't happen that often in stocks on a daily basis or in markets on a daily basis. So when that happens, you may hear reports about it in the press. Now let's look at how to set up exponential moving averages on a few charts and see how the indicator works. We're going to start by looking at the dollar-yen currency pair. We're going to assume we're trading this currency pair on an hourly basis. And as always, we're going to start with a larger time frame to get an idea of whether the pair is trading in a bullish, flat, or bearish market. We can see here on the daily chart, the pair moved down at the early part of the year in a bearish trend, bottomed in the March-April time frame, and then has moved up through the July-August time frame in a bullish pattern with a few pullbacks in late May, and we're in another pullback right now. To me, this pattern is fairly neutral. I wouldn't call it bullish or bearish at this point. We seem to have some support around 110. We had price action around this level in February, again in May, and in June. And the pair has bounced off of this level again in mid-August. So we have a fairly neutral stance with 110 being something of a support level. We're not going to look at a 4-hour chart before we go to our hourly trading chart. The 4-hour chart is fairly bearish. But again, we know we have support here around 110, and the stock is trading close to that. So we may either want to look for another bounce off of 110 or for the pair to break through 110 to the downside. So that's the information we have going into our hourly chart. Now we're going to go to the hourly chart, and we're going to set up our exponential moving average. We're going to go to indicator at the top, type in EMA, to get moving average exponential. We'll close that. We'll come over and these are our settings for our moving average. And what we're going to use is a 20-day and a 5-day. Our 20-day is going to be our slow line, and our 5-day is going to be our fast or our signal line. So we'll start by clicking on Format, and we'll make this our fast line. And first, we'll make it a 5. And then for style, we're going to make this a green line. I hit OK. And now we're going to hit indicator again. EMA. This is going to be our second slow line. So go here to Format, and we'll type in a 20. And we're going to make this a red line. So what we're going to be looking for is a cross of our green line over our red line. And let's look at how that's worked in the past couple of days on the hourly chart in this currency pair. We have a cross of the green line here when the pair was at 110.84. We'll see the pair sold off. We have another cross to the upside at 110.56, which lasted only a short time, a couple of hours. Another cross back down to the downside, and that's when we had the test of the support level around 110. The pair dropped to 109.80 and bounced there. And you see the EMA cross here for a buy signal and back down. You can see there are a lot of crosses of the EMA. So generally, we're going to be using the cross signal along with another signal, such as a relative strength indicator, which we'll talk about later, or a candlestick pattern. So I'll show you a quick example of 2 candlestick patterns to go along with the EMA. And we'll go over these candlestick patterns in more detail later. But this pattern, where we have a red candlestick, remember the red is the down candlestick, after a green candlestick, and the red is larger, it's a bearish engulfing pattern. So if we see that pattern, we're then going to look for a cross to the downside to confirm the pattern. And here we have that cross down. The pair trades down, and here we have 2 candlesticks together that are about the same length. The first one is a continuation of the downtrend. So this is a down hour. And then we have an hour that's an up hour just after the down hour that matches this candlestick. And this is a bullish pattern. After we see a bullish candlestick pattern, we're going to be looking for a cross to the upside. This would be our buy signal here. And remember, with each trade that we place, if we have a buy signal here, we're then going to have a stop. And depending on our trading plan, it would be somewhere below this level. And what I might do in this case is if we purchased here, we may want to use this low where our candlesticks indicated a turn in the pair as our stop point. As we can see, we would not have been stopped out and the pair rallied. So that's how to use the EMA on a short-term time frame. And now let's take a look at an EMA pair on a daily chart for a stock. Let's take a look at a daily EMA for the S&P 500. This is a 50 and 200 day EMA, which is fairly common for identifying long-term trends in markets and stocks. You'll note the market had been in an uptrend in late 2015, which it had been in for several years, and there was a cross here of the 50-day below the 200-day. And if you were trading the market at this time, you would have heard a lot of chatter about the golden cross to the downside. People became anxious around this point, and if you were trading long-term, this would have been a good time to either exit or short the market. But as you'll notice, in April of 2016, the 50-day moved back above the 200-day and has stayed there ever since. This golden cross to the upside kicked off another leg of the bull market in 2016, which has lasted until today, with no crosses below the 200-day exponential moving average. Thank you for watching this video on the exponential moving average. We'll see you next time when we'll talk about the parabolic SAR indicator. See you there. And today we're going to talk about the parabolic SAR and how to trade with this indicator. The parabolic SAR is also known as the stop and reversal system. The indicator is best used in a trending market, so we're not going to be using this indicator in a sideways market. We will have already identified either a bullish trend or a bearish trend in the stock or market that we're trading in order to use this indicator. The indicator is represented by a series of dots, which we'll see in just a moment, below the price in a bullish trend, and a series of dots above the price in a bearish trend. The indicator is best used as a way to set a stop for our trade when we're long in a bullish trend or short in a bearish trend. And you'll see how we use the indicator to set stops in the charts. So let's take a look at a few charts and see how the parabolic SAR can help our trading. Well, we'll be trading on an hourly chart. We're going to start with the daily chart of Microsoft, as we usually do, to identify the trend. As we said before, the parabolic SAR works best in a trending stock. So we can clearly tell from the daily chart that Microsoft is in a bullish trend. So now let's go to our hourly chart first. And at the top, we're going to click on indicators. We're going to type in PAR. You see the parabolic SAR here. Click that. Close this box. And we see the parabolic SAR as the stock is moving up. You can see the dots are underneath of the price. And then as there are pullbacks in the stock, you'll see the dots shift to above the price. Since we know the stock is in a bullish pattern, we're only going to be trading the long side. So if we start here on July 11th, we'll have a buy signal as the dots go under the price. We would get long here. When the dots shift here on July 16th to be above the price, that's our stop. So we would sell at that point. We would have another buy indicator here and a sell. We would make very much on that trade. We wouldn't get back into the stock until here on July 19th when it enters another uptrend, and this would be our stop. At this point, on July 26th, we'd be back out of the stock. We wouldn't enter back into the stock until the 31st. We basically trade flat on this trade. We'd be stopped out here. Enter back out on August 2nd. We'd have a nice move to the upside here, and so forth. That's how this indicator works on an hourly chart with Microsoft. Again, it's an indicator that you would preferably use in combination with other indicators or with other candlestick patterns. So let's take a look at how it looks on another chart. So let's take a look at Johnson & Johnson, which has been in a bullish trend for the past few months, given our daily chart. Again, we'll be trading on an hourly basis, but we're going to start with a daily chart. We see the uptrend here. So let's take a look at our hourly chart. We're going to pull back, give us a few days of trading time here. But begin on July 25th, we would have had a buy signal here, entering around 128. An exit signal around 132. We would have had a buy signal here. This would have been a flat trade. We would have stayed out of the stock from August 6th through the 14th, and then another buy signal here on the 15th, just above 129, which would have kept us in the stock until August 21st, around 135. So that's the parabolic SAR on an hourly chart. Again, this indicator is best used with a trending stock or market, and is also best used in combination with either candlestick patterns or another indicator. So that covers the parabolic SAR. which is an indicator designed by Wells Wilder, who also designed the relative strength indicator, which we'll be talking about in a couple of videos. The next video will cover the MACD, or Moving Average Convergence Divergence Indicator, which happens to be one of my favorite indicators. We'll see you in the next video. We're going to continue our discussion around technical indicators, and we're going to be talking about the Moving Average Convergence Divergence Indicator, or the MACD. So let's jump right into the MACD. If you remember a couple of lessons ago, we talked about exponential moving averages. The MACD is a combination of a couple of different exponential moving averages. So it's the 12-day EMA subtracted from a 26-day EMA. And that gives us one line, which is our slow line. Our fast line is a 9-day EMA, and that's our signal line. And then finally, we'll have a zero line that these two lines will cross above and below as a stock trades. There are a couple of different things that we're looking at in the MACD to give us a signal, buy or sell signal. The first one is a cross of the 9-day above or below the 12 subtracted from the 26-day EMA. So when the 9-day signal moves above the slow line, that's a bullish sign. When the 9-day signal moves below the slow line, that's a bearish sign. We also have the zero line, as I talked about a minute ago. When both lines are above the zero line, that means that the fast signal 9-day line is above the slower line, and that's bullish. That means the stock is in an uptrend because the closer in prices are moving up. When the 9-day signal and the slow line cross below the zero line, that's a bearish signal as the close-in prices are moving down. Remember, the EMA is a momentum indicator, and it's also based on historical prices. The final thing we're going to talk about, and that we'll look at in the charts in just a minute, is a divergence. When a stock moves higher, but the MACD moves lower, that's a divergence. The same thing happens when a stock moves lower, but the MACD is moving higher. What this indicates is that the price in the direction that it's moving is starting to slow and could possibly change trend direction. So you have a divergence between the stock price and the direction of the MACD, which again is indicating a possible trend change. Okay, let's look at the MACD on a couple of charts and see how we trade with it. One note on the MACD is that it works in any time frame. So we can use it on a daily chart to trade daily moves. We can trade it hourly or even on a minute chart. So unlike some of our other indicators, which work better either long-term or short-term, the MACD works in any time frame. Let's look at the charts. Let's take a look at the chart of Intel on a daily basis. We can find our MACD under indicators at the top. Click that. Simply type in MACD. That applies our MACD indicator. Close this box. So the MACD is displayed on the bottom of the screen. Our fast line here is our blue line. So that's our signal line. This is the zero line for the MACD. And you can see as the MACD is above the zero line, the stock is in a bullish pattern here. It goes back down and touches the zero line. Our fast signal line drops below, but then the stock goes back into a bullish pattern here. This cross on February 22nd is a buy signal. We'll see the stock moves up. We get a sell signal on the 19th. Then the stock trends sideways to slightly up. And we get a MACD that stays positive but isn't moving higher. And here I want to point out the high in March. And you see the MACD at the level it's at. And then as we move forward to May and June, you see that the stock price has moved higher than it was in March, but the MACD has actually moved lower. And that's a divergence. This would be a warning sign that the trend is about to shift. And we get a sell signal on June 7th, and then the stock moves down again. And that's the MACD on a daily basis. Now let's take a look at a shorter time frame chart. Let's take a look at an hourly chart of Microsoft. Let's begin here on June 26th we see a cross to the upside, a cross to the downside. And what you'll notice is that there are a lot of crosses in Microsoft with the MACD at various levels. These crosses can get us in and out of the market without much gain and cost us in transaction fees. So one way to trade the MACD is to only use crosses and extreme levels or around the zero line. So if we do that here with Microsoft, an extreme level would be around -70 and +70. So if we only take those crosses, we have an oversold condition in the stock here, a positive cross. The stock moves up. We have an overbought condition, so we would have exited that trade here. Stock comes back to the zero line, and we have another buy signal here. We would enter this trade and exit on this cross in an extreme overbought condition. The next cross of the MACD at an extreme would have been here in July. We would stay long till here, and we see a cross here, but it's not in the extreme condition, but it's getting toward overbought at this point. So we might be wary, and we'd also want to use our candlestick patterns to inform our trading. But you can see on the hourly chart that the MACD may give you too many buy-sell signals. So again, you can use the extreme overbought and oversold conditions and the zero line to inform your trading. So that's the moving average convergence divergence indicator, or the MACD. And again, it's one of my favorite indicators, especially when using it at the extreme levels that we talked about on that last chart in combination with candlestick patterns. Thank you for watching this video on the MACD. And our next video will be talking about the relative strength index. And I look forward to seeing you there. We're here in module 2, looking at technical indicators. And today we're going to be talking about the relative strength index and how to trade the relative strength index. The RSI is a momentum indicator that measures the magnitude of recent price changes to help identify overbought or oversold conditions. So what we're looking for is a change in trend when we're looking at the relative strength index. The formula for the RSI is RSI equals 100 minus 100 over 1 plus relative strength. This is with a 14-period default time frame. So it's either 14-day, 14-minute, or 14-hour. It doesn't matter. The RSI works in all time frames. The values for the RSI range from 0 to 100, with 70 being overbought and 30 being oversold. So anything over 70 or below 30, we're looking for a trend change. Since RSI is measuring recent price, it is also a momentum indicator, just like our other EMA indicators and the MACD. The RSI indicator can give false signals, just like we saw with the MACD in our last video. And so some traders use the numbers 80 and 20, so above 80 and below 20, and only take signals generated with those parameters in order to avoid false signals and overtrade with the RSI. Again, the RSI is an indicator that's best used with candlestick or other chart patterns to deliver the best results. So let's take a look at a few charts using the relative strength index. Let's take a look at the stock of Walt Disney on a daily chart using the RSI. So go up to indicators, type in RSI. We see the relative strength index comes up. Close this spot. We see the relative strength index is located on the bottom of our screen. These are the levels we talked about. 70 to the upside and 30 to the downside. We can see first off that the relative strength index doesn't give a lot of signals. We have a buy signal here, here, a couple of sell signals here, here, and then later in the chart. But it mainly trades in the range between 70 and 30. So let's take a look and see how the RSI worked with Disney. So on this buy signal in May of 2017, the stock did trade up slightly, but then turned back down. Kept trending down. We didn't have another buy signal until September. And at this point, the stock traded in a pretty tight range for a couple of months. It put in some major support at these levels. So a buy here would have worked. We wouldn't have been stopped out. And then the stock went into an uptrend. We had our first sell signal here in November. And then our second sell signal. Now, note this one is at the 80 level that I said some traders use so they don't get false signals with the RSI. And if we had sold at this level near the top, near 110, the stock really didn't trend that much higher and then turn down. So this RSI indicator of an oversold condition was correct. The stock traded down. We get another overbought condition. Here in June, the indicator was correct. Stock trades down a few percentage points and then trades back up. And right now, Disney is trading in an overbought condition. And something to note, the overbought condition, as again I said we should use the RSI with other indicators, that overbought condition also happens to be around resistance for the stock. Now let's take a look at the RSI on a shorter time frame. So let's look at RSI on an hourly basis with DEER. Again, there are not a lot of signals, but we get an overbought signal here on the 9th. If we had sold out of or shorted our position at that point, the RSI was correct. We get down into an oversold condition here on the 13th. Again, the RSI calls this one correctly. The stock moves up. A slightly overbought here, but not really peaking out very much on the RSI. Not much of a signal there. But the stock does drop. And we don't get another signal. We get close to overbought a couple of places as the stock is trading in a range here on the 26th and here on the 7th. The stock does turn down at this point, and we get several oversold indicators in a row here, another one here, and you'll see a divergence here. The indicator isn't dropping as much as the stock, which is lower. So the indicator, the RSI, is lower here when the stock is at 136 and then turns up and it's higher when the stock is down at 134. So that would be a more bullish indicator than just the RSI signal by itself, but taking a couple of signals together. And then we get a nice move up in the stock after this signal. Again, the RSI should be used in combination with either other indicators or with chart patterns, such as candlestick patterns, which we'll be talking about in the next module. So that completes Module 2 on chart indicators. And as I said, in the next module, Module 3, we'll be talking about chart patterns and candlestick patterns. I look forward to seeing you there.